Hi there. In this video, we explain the 2026 mortgage borrowing rules every UK homebuyer must understand. Stay with us to learn how lenders assess income, affordability, and risks before approval.
Hello and welcome. In 2026, probably the biggest question for anyone looking to buy a home in the UK is this: how much can you really borrow? Well, the answer might be a whole lot more than you think. This entire breakdown comes from the expert tax advisors at ProTax Accountants, so let's get right into it.
So let me ask you something. Do you think you can only borrow 4.5 times your salary? For years, we've all had that number drilled into our heads. It's the rule of thumb that's become, well, almost gospel. But what if I told you that in 2026, that rule isn't just a bit outdated, it could be the very thing holding you back from the home you actually want?
Have a look at this number, £480,000. Now, this isn't a lottery win. Believe it or not, this is what a couple with a joint income of just £80,000 could potentially borrow this year. That is £120,000 more than the old 4.5 times rule would ever suggest. I mean, that's an entire deposit for another property in some places. So, how on earth is that even possible? Well, over the next few minutes, we're going to break it all down. We'll talk about the new rules of borrowing, and we'll bust that 4.5 times myth wide open. We're going to look at how lenders actually decide what to offer you, how you might be able to join the exclusive 6 or even 7 times income club, and most importantly, we'll walk through some really practical steps to maximize your own borrowing power. Okay, first up, the new rules of borrowing. You know, the lending world has shifted more in the last couple of years than it has in the past decade, and 2026 is really proving to be a game changer for anyone trying to get on the property ladder.
So, here's the absolute key change. Regulators like the Bank of England have scrapped the old, really strict 3% interest rate stress test. Now, this was a rule that forced lenders to check if you could still afford your mortgage if rates suddenly shot up by 3%. Honestly, it was a massive handbrake on borrowing for so many people. With that gone, lenders now have a lot more flexibility to look at your specific situation and figure out your real-world affordability.
So, with that old rule out of the way, what's taken its place? Well, this brings us nicely to the 4.5 times myth and the big shift from a simple one-size-fits-all calculation to a much smarter, more personal way of looking at things. This really shows the difference perfectly. The old way was just blunt. Take your gross salary, multiply it by 4.5, and that's it. That's your limit. And this catches so many people out because they still think this is how it works. But the 2026 way is totally different. It's a proper detailed review of your affordability. Lenders look at your total income. Then they subtract your fixed commitments, and they figure out your true borrowing power.
And the difference this makes is just dramatic. Look, on a £50,000 salary, the standard 4.5 times multiple gets you a mortgage of £225,000. But if you find the right lender with an enhanced multiple, that could jump to £300,000. And for some professions, it could even hit £350,000. That extra 125 grand, that's not just a number on a screen. That's the difference between a 1-bed flat and a 2-bed house, or getting into the right school catchment area for your kids.
So, this leads us to the most important question. How do lenders really decide? Because it is so much more than just what's on your payslip. Now, stay with me here. This is where a lot of people get confused, but once you understand this, you can unlock so much potential. First off, lenders want the full picture of your income. It's not just about your basic salary. They'll often average out your bonuses and any commission you've earned over the last couple of years to see that it's consistent. They'll look at regular overtime, profits from self-employment, and even other steady income like car allowances or stipends. Every single reliable income stream counts.
And then they look at what goes out, and this is just as important. They'll add up all your fixed financial commitments, things like credit card balances, personal loans, car finance deals, and of course student loan repayments. But crucially, they also factor in big regular costs like childcare and how many financial dependents you have, because all of that directly affects how much disposable income you have left each month.
This all gets crunched into a key number called your debt-to-income ratio, or DTI. Now, in simple terms, it's just the percentage of your monthly income that's already spoken for by debt payments. A lot of lenders use a guide like the 28-36 rule, where they like to see no more than 28% of your income going towards housing and no more than 36% going towards all of your debts put together. A lower DTI ratio tells them you're a lower risk borrower, and that makes you a much more attractive customer. All right, now for the part you've probably been waiting for, joining the 6 and even 7 times club. Let's look at the specific lenders who are offering these higher multiples and, crucially, who actually qualifies for them.
You'll definitely want to hear this part.
Okay, so these deals are absolutely real and they're available right now in 2026. You can see here that Nationwide's Helping Hand scheme can offer up to 6 times income for first-time buyers. Barclays can do the same for couples with a joint income over $75,000. And then you have specialists like April Mortgages and Teachers Building Society pushing things to an incredible 7 times income, as long as you meet their specific criteria, like being a teacher or locking into a longer-term fixed rate.
So what does a lender mean when they say a professional? Well, it's not just a fancy title. It's all about risk. Lenders see these careers as having really stable, predictable salary growth. So we're talking about doctors, lawyers, accountants, teachers. These are professions they view as lower risk. And because of that, they're often happy to grant them access to much better borrowing terms and those higher multiples.
Let's make this real for a second. Imagine a newly qualified teacher and her partner on a joint income of $55,000. The old 4.5 times multiple would cap them at under $250,000, probably pricing them out of the city. But with the Teachers Building Society's 7 times multiple, they borrowed $385,000. That difference was enough to get them their first home in a really competitive market like Bristol.
And here's another one, a junior doctor in London earning £78,000. At 4.5 times, they can borrow $351,000, which, let's be honest, is not nearly enough for many parts of the capital. But by using NetWest's 5.5 times scheme, their borrowing power jumped to over $429,000. That extra bit of headroom made buying in London a reality instead of just a distant dream.
So now you know what's actually possible. How do you go about achieving it? Let's talk about maximizing your borrowing power with 4 clear, practical steps you can take, often starting months before you even think about applying.
Okay, step 1, get your debt down. Every single pound you pay off a credit card or a loan directly improves that DTI ratio and boosts what a lender thinks you can afford. Step 2, polish your credit score. Simple things like making sure you're on the electoral roll and never ever missing a payment make a massive difference. Step 3, save a bigger deposit if you can. Getting to 15% or more often opens the door to the very best deals and those higher multiples. And finally, step 4, and this is vital, use an expert broker. They know the market inside out and have access to deals you just can't find by yourself online.
And here is a pro tip for you. Lenders absolutely love certainty. If you commit to a longer fixed-rate mortgage, say 5 years or more, it removes their risk of your payments suddenly jumping up if interest rates change. That security you're giving them often gives them the confidence they need to offer you a much higher, more generous income multiple in return. It's a smart move.
And that brings us to our final section, your next steps. Because now it's time to turn all of this knowledge into some real, decisive action.
So, we'll leave you with this question to think about. Knowing that the old 4.5 times rule is no longer the hard limit, and that you could potentially borrow so much more than you probably thought, how does that change your property plans for 2026? Does it open up new areas you thought were out of reach? Maybe a different type of home? Or maybe it just makes the whole idea feel possible again? It's a powerful thing to consider.
Now, before we finish, it is really important to state that the information here is for general guidance only, and it's accurate as of February 2026. Your home may be repossessed if you do not keep up repayments on your mortgage, and you really shouldn't rely solely on this information when you're making major financial decisions.
Because everyone's situation is so different, the absolute best next step is to get a personalized assessment. We highly recommend you consult the experts at ProTax Accountant. You can get in touch with them on WhatsApp or by phone at 07985689912, or just drop them an email at info@protaxaccountant.co.uk. For all the details, you can read their full article on the blog. And of course, please do subscribe to the channel for more updates just like this one. Thanks so much for watching.